Welcome to The Deep Dive. Today we're jumping into Michael Lewis's book, The Big Short, Inside the Doomsday Machine.
And we've looked at, quite a few reviews and summaries to really pull out the key ideas.
We want to understand the book's take on the 2007-2008 financial crisis and the different views on Lewis's portrayal.
Exactly. So maybe you've heard about it or, seen the movie adaptation.
But our mission here is to dig a bit deeper, using what the critics and analysts have said about the book itself.
Get a more, let's say, nuanced picture of the whole thing.
Okay, so the core of it, The Big Short. It's basically this story, right? About a few people who saw the housing bubble inflating.
And they didn't just see it, they bet against it. A huge bet against the entire market, really.
Which was definitely not the popular view on Wall Street at the time. Lewis really paints them as outsiders, doesn't he? Contrarians.
He does. And his main argument, the one that comes up again and again in reviews, is that this crisis wasn't just some random event.
No, he pins it on, corruption and greed, particularly in that subprime mortgage market.
That's the angle, that firms were, knowingly pushing these really dodgy loans onto people, fraudulent even.
All for the short-term profit, ignoring the obvious risks down the line.
And it gets more complicated because it wasn't just the bad loans themselves, it was these instruments built on top.
The CDOs.
Yeah.
Collateralized debt obligations.
Right, these incredibly complex financial products. They bundled up thousands of these risky mortgages.
Making it almost impossible to see the garbage hidden inside, I guess.
Pretty much. And Lewis introduces us to the people who did see it, or claimed to. Michael Burry, Steve Eisman.
Partly Ledley and Jamie Mai from Cornwall Capital, too.
Yep. The underdogs in Lewis's narrative who saw the cracks forming while the big players seemed oblivious.
Now, talking about Lewis, reviewers consistently praise his writing style, don't they?
Oh, absolutely. He's got this knack for making super complex financial stuff. Well, readable, even entertaining.
He focuses a lot on the personalities, the drama of it all. Makes it feel like a thriller sometimes.
And that skill is key, because reviewers say the book gave people these real aha moments about the crisis.
Explaining why it happened in a way other accounts maybe didn't.
Exactly. Showing Wall Street's blindness, maybe willful blindness, driven by those short-term profits and maybe a lack of, scruples.
But it wasn't just individual greed, according to Lewis in the reviews. It was systemic.
That's a crucial point. The system of incentives that channeled the greed. That's a key phrase.
Meaning the whole structure encouraged risky behavior, misaligned interests everywhere.
Precisely. And there's that quote from John Gutfreund Lewis uses, "It's laissez-faire until you get deep in the shit."
Suggesting they expected a safety net, a bailout if things went wrong.
Seems like it. Which points to another disturbing idea reviewers picked up on, the stupidity factor. That maybe some powerful people weren't necessarily evil geniuses, but they just didn't understand the risk.
They didn't grasp the complexity of the things their own companies were trading.
Which is almost more terrifying, in a way, that lack of understanding at the top.
And Lewis suggests this isn't a one-off, right? The book hints that the system itself breeds these kinds of crises.
That's a strong theme. These perverse incentives, they haven't necessarily gone away. They could lead to repeats.
So understanding The Big Short becomes kind of essential for understanding the world after 2008, how things changed.
Many reviewers make that exact point. It explains a fundamental shift.
Going back to the guys who did see it coming, what lessons do reviewers pull from their actions? Research seems key.
Definitely. Doing your own homework, not just trusting the official ratings or what everyone else was saying.
They dug into the actual mortgage data, questioned everything.
And patience, that's another big one. They had to wait, sometimes for years, for their bets to pay off, while facing a lot of pressure.
They weren't quick money, and it required taking a pretty big calculated risk.
Going against the herd, putting real money behind their convictions.
There's also talk about their humility, being willing to admit what they didn't know.
Yeah, that openness to learning, constantly questioning if they were the ones who were wrong. It's an interesting characteristic.
And then, of course, the big flashing warning sign. The danger of greed blinding everyone.
Can't miss that one. Ignoring the long-term consequences for immediate gain.
Reviewers also mention things like adaptability, honesty, taking responsibility. Other takeaways from the stories?
Lots of potential lessons packed in there.
So, okay, let's get into the how. How did they actually make these bets? You mentioned shorting.
Shorting just means betting that an asset's price will go down. But it wasn't straightforward with mortgages.
Especially these bundled mortgage securities. Michael Burry had to basically invent a way, didn't he?
Pretty much. He had to convince the big banks, like Goldman Sachs and Deutsche Bank, to create a specific product for him.
These credit default swaps, or CDSs.
Exactly. Think of a CDS like an insurance policy on a bond. Burry paid a premium.
And if the underlying mortgage bonds defaulted, the bank selling the swap had to pay him.
Yep. He was insuring against a collapse he saw coming, even without owning the bonds themselves.
And Cornwall Capital, Ledley, and May, they had a slightly different approach. Event-driven.
They looked for mispriced risk, especially in options, opportunities where the market seemed to misunderstand the odds.
And they didn't just short the really junky stuff, did they? They went after supposedly safer tranches, too.
That's right. Even AA-rated parts of these CDOs, they figured the whole structure was rotten, even the parts that looked solid.
Using options gave them a way to make a leveraged bet with, theoretically, a limited downside if they were wrong.
A calculated risk, based on their analysis that the underlying mortgages were far worse than the ratings suggested.
Okay, this is getting deep into the mechanics. And if you're finding this deep dive valuable, maybe pause for a second and hit like or subscribe. It helps others find the show.
So moving on from how they bet, let's talk about why the system allowed this to happen. The systemic failures.
A big one seems to be moral hazard with the lenders.
Definitely. The people originating the mortgages, the lenders, they weren't holding on to the risk.
They just packaged the loans up, sold them off.
Exactly. Sold them to Wall Street banks who turned them into CDOs. So the originator had little incentive to care if the borrower could actually repay. Their profit was upfront.
Passing the buck, essentially.
And then the sheer complexity and opacity of the CDOs themselves, we touched on this.
Few people really understood them, even the experts.
It seems so. Including the ratings agencies, Moody's, S&P, they were supposed to be the independent judges of risk.
But they had a massive conflict of interest.
The banks paid the agencies to rate these products.
So the incentive was to give good ratings, like AAA, to keep the business flowing, even if the product was, well, junk.
Led to wildly inflated ratings on incredibly risky securities. Plus, the bond market itself just wasn't regulated as tightly as the stock market.
A perfect storm of bad incentives, complexity, and lack of oversight.
So what happened when it all started to unravel? Lewis describes a time lag, right?
Yeah, the bad loans were made, but defaults didn't spike immediately, partly because of those low teaser interest rates.
And as long as house prices kept rising, people could just refinance. But once prices stalled or fell,
and those teaser rates reset higher, defaults started climbing fast.
But the complex structure meant the pain wasn't felt right away in the CDOs, and the market for insuring against defaults, the CDS market, was murky.
So Wall Street was slow to react. Denial.
A lot of denial, resistance to acknowledging how bad it was, reluctance to reprice those CDSs accurately until they couldn't ignore it anymore.
And then the collapse was huge, leading to those massive government bailouts.
Bear Stearns, Fannie Mae, Freddie Mac, AIG, iconic names needing rescue to prevent, arguably, a total system meltdown.
Which brings up the controversy. Lewis definitely highlights the view that the people responsible didn't really pay the price.
Many argue they faced few consequences, and some even profited from the bailouts or walked away rich before the crash.
He mentions people like that CDO manager, Wing Chow. Made millions, then his fund blew up, but he kept his personal fortune.
It feeds that narrative of unfairness, that the system protects the insiders.
And Lewis also suggests, quite shockingly, that some CEOs at the very top were just ignorant of the risks their firms were taking.
The Howie Hubler story at Morgan Stanley is a prime example in the book. A massive loss stemming from complex bets few seem to truly grasp.
Suggesting a failure of management and understanding, not just greed, at the highest levels.
It's a complex picture. Now, The Big Short was hugely successful, but it's fair to say there are criticisms too.
Some argue Lewis maybe lionized these short sellers a bit too much, made heroes out of guys who profited from disaster.
That's one perspective, that they were still part of the system, just playing it differently.
The counter-argument being, they were betting against a system that deserved to be bet against, because it's fundamentally flawed.
Right, and there's the debate, were they brilliant analysts or just lucky they took huge risks? What if the government had stepped in differently?
Like bailing out homeowners directly on a massive scale.
Wow.
That could have wiped out their shorts.
Exactly. And then there's the uncomfortable fact that many who were wrong, the CEOs overseeing the mess, often still walked away incredibly wealthy.
Raises that question.
Oh.
Who really paid?
Some critics also feel Lewis may be focused too narrowly on subprime, overlooking other potential factors like, say, monetary policy.
Fair points to consider for a full picture. But the book's relevance today seems pretty clear.
Undeniably. You see echoes, don't you? In crypto crashes, meme stock frenzies.
That same mix of hype, complexity, maybe hubris, misaligned incentives.
The patterns seem familiar. It's interesting that some of the original Big Short figures are reportedly now betting against new potential bubbles.
History repeating, perhaps, or at least rhyming.
So wrapping up, The Big Short gives us this really compelling narrative about the 2008 crisis.
It emphasizes that toxic mix: unchecked greed, dangerous complexity in finance, and major systemic flaws.
Lewis tells it brilliantly, though we should remember it's one interpretation, one narrative focus.
And it really leaves us with a big question to ponder, doesn't it? Looking at the financial world now, have we actually learned the lessons? Or are the incentives still set up for the next Big Short?
Something to keep considering.
We definitely encourage you to think more about it. And hey, if you want a visual guide to all the players and concepts we discussed,
check out the description below. We've put together an exclusive interactive book mind map just for our listeners.
It's a great way to connect the dots. Thanks for joining us for this deep dive on the deep dive, part of the Inspired Podcast Network.
We really hope you found this useful. If you did, please do like and subscribe. It helps us keep bringing you these explorations.